All right, welcome back to the Compassionate Capitalist Show. And I am excited about our topic today because one of the things that as the focus of our Compassionate Capitalist Show, it's all about wealth creation, first and foremost, as a successful entrepreneur, and second, as an investor in a successful entrepreneur, whether that's as a private equity investor, an angel investor, the old term silent partner. So many names for someone who invests their capital into private entrepreneur endeavors, small business owners, right? And my book, Inside Secrets to Angel Investing, which is available wherever books are sold, and autographed ones are available on my website, inside secrets to angelinvesting.com. Sorry, it's a brazen self-promotion, I know, but it's really a primer. This book, would you, could you, should you take part of your liquidity, invest in private companies as an asset class like public stocks and real estate? And in fact, one of the questions I get, sort of like on a parallel path, I actually talk about in the book, is real estate investors that mirror, their similar strategy mirrors a lot of ways people get involved with angel investing. Do you want to have a reoccurring revenue stream? Do you want to flip it? Want to have a big ROI from a long-term investment that multiplies? But the question I often get and the comment I get is like, hey, Karen, I want to invest in entrepreneurs and innovation. But I don't have a lot of liquidity and I don't have much wealth to invest in multiple companies. One of my rules is you don't even get started if don't have a strategy of how you're going to lay out multiple investments. But they want to know, how do I get a golden egg to use for angel investing? And particularly those younger investors that are in that 30 to 45-year-old range, that they may have reached a point in their career, they're making $200,000, $300,000. They've got a good 401k, but they just don't feel like they have any extra to put towards equity investment because they're buying their first house, they're starting up their family, things like that. And they don't want the instability of cryptocurrency. They may have invested in low entry dollar amounts in crowdfunding, but those returns are way off. And so what are their options? Well, ladies and gentlemen that are listening, my investors and entrepreneurs here on the show, my guest today is going to tell you how he not only helps investors grow their wealth and discretionary income, but how he also uses it for good. He's a compassionate capitalist in his own right. His name is Martin Saenz at Bequest Funds. I'm going to let him say hello as I do the rest of my introduction. There he is. If you're those that are watching on YouTube. He just waved for those that are just listening to me to describe my oratory here. So anyway, Martin Saenz brings a social good into smart investing. He is a managing partner of Bequest Funds and a renowned thought leader in the mortgage note investment industry. And I'm going to come back to this in just a second because I had a shared history when I was approached to having Martin on my show, and I was like, I'm totally listening to this because I almost got involved, or I tried to early on, thought about it, doing mortgage notes. And it's not every type of investment is complex, I think. And you think it's just, oh, this is simple stuff. It's not simple stuff. And that's why, he has a whole firm, Bequest Funds, that helps people with this. And so anyways, we're sort of a kindred spirit. He's passionate about creating a better world through profitable businesses. He works hard to share and spread that success. That's one of the reasons why he's a guest on this show. And together with his business partner, Sean Munoz, Martin has co-founded the Bequest Funds with the dual purpose of helping investors grow their wealth while also helping mortgage borrowers stay in their homes, which is a really critical thing right now after we're coming out of this pandemic. We have a lot of financial turmoil, in the marketplace. We have a skyrocketing nature of our mortgages. There's just a lot going on in the real estate space, a lot going on with people's income, the impact COVID had on their savings, on their ability to pay their bills, all that kind of stuff. So it's really great that Bequest Funds has the focus that they have. And we're going to talk about that. And so quickly, Bequest Funds manages reliable, high yield opportunities for accredited investors and their diversified portfolio of reperforming residential mortgage notes with a impressive, predictable return. So thank you again, Martin, for being a guest on the Compassionate Capitalist Show.
Yeah, Karen, thanks for having me on. Much appreciated. And thanks for that thorough introduction.
Yeah, yeah. So okay, so mortgage notes, that's an interesting kind of niche area in the financial services space, and it's not, and your fund itself and the way you do this is not just sort of like a traditional real estate investment fund that people might think about where they go, is investing in lots of different types of income producing properties or doing other kinds of investment stuff. Tell us how you got started with in real estate in general, in financial management in general, and then how you settled in on these I'm sorry, these mortgage notes, because it was something that long time ago when I first left the corporate gig and I was thinking about getting started doing this. I had a lot of things in the fire. I was looking at ways to make money, and I bought a kit, if you will, and an ebook of, or actually it was like back before ebooks where they were just basically files somebody stored on a drive, and I don't even know how much I paid for it. And I looked at this and I was like, wow, that is not for the average bear to do. And that is something that takes commitment to understanding it, learning it, and then mastering it in order to get good at it on a consistent basis. And you have impressive predictable returns with bequest funds. So share with our listeners how this came about.
Sure, sure, absolutely. I'd be happy to. So, after I'll kind of start in the early 2000s, I got my MBA and I was out there, got a job with corporate America. Realized in a few years that was not the direction for myself or my wife. We had big financial aspirations. We wanted to earn passive income. We wanted to retire financially free. And we realized, going through the corporate track, it was not going to get us there in the time period we were looking to get there. So in 2005, we formed a government contracting company that sold goods and services to the federal government. And in hindsight, I think learning how to sell to bureaucrats was very helpful in learning, navigating through the mortgage note industry and all that, how convoluted it is years later. But with that said, we started acquiring real estate as landlords, both commercial and residential, in '09 in the Washington, D.C. area. And we still have managed a portfolio of properties to this day. However, in 2013, we sold the government contracting company, and I was looking for something to do. So I had expertise in landlording on the real estate side. So, through my networking channels, I stumbled across a mortgage note investor, and it was really kind of intriguing because I'm like, what is this? What is this thing called mortgage note investing? I understand real estate, I understand hard assets, and it's really the other side of the same coin. And what I found is that you can be the bank and go out and buy a mortgage that's already originated, that's already paying on a monthly basis, and then you can create a long-term cash flow stream for yourself. And so that's essentially how I got started, with one caveat. I purchased mortgage notes at a discount in a non-performing state. So these were mortgages where the homeowner hadn't made a payment in 4 or 5 years. I bought it from another hedge fund or bank for 30, 40 cents on the dollar. And then I worked out payment plan terms with the homeowner that they could afford to help keep them in their home while creating a long-term cash flow stream for myself and my company. And that's really how I got started out of the gate, purchasing these mortgages mainly in a defaulted state when I first started doing it. Now we have 2 separate funds. We actually purchase still the distressed mortgages and help homeowners stay in their home, but we also purchase performing mortgages that pay out a 9% return to our investors.
Oh, okay. So that's really interesting. So Because I always hear, so you look at, do you buy like an aggregate of notes from one lender that has a lot of non-performing default state ones, and then they kind of bundle them so that you get them, or is the discount just simply because they're not performing and they want to get them off their books?
Yeah, well, sometimes it's a matter of flipping. There's a lot of parallels between the mortgage note industry and the real estate industry. Sometimes you have a hedge fund that buys non-performing mortgages at 25 cents and wants to flip them out at 50 cents on the dollar. And sometimes you have hedge funds that buy the mortgage in a non-performing state, create a loan modification, re-season the mortgage, and then sell it into our income fund at an 11 to 13% yield, thereby allowing us to pay out 9% to our investors.
Okay.
So there's a few different ways, these mortgage notes gets purchased.
Okay, so, and then do you within bequest funds then go through and work with each individual mortgage owner, the homeowner, to like figure out and refinance it, or do they just you hold the mortgage as is and they just pay you a longer term on that because or they're just getting caught up, and so you take the what has been missed and just kind of put it on the back end without having to try to struggle to get caught up?
Yeah, so Bequest Funds is our performing mortgage fund. So it actually only purchases mortgages in that are performing in our season. So
Oh,
they
okay.
actually cash flowing out of the gate. We just purchase them in at a discount at an 11 to 13% yield, even though the coupon rate may be 5-6%. We're buying them in at a discount, allowing us to pay our investors 9% on a monthly basis. So how it works is we go out, we source a pool of performing mortgages at, let's say, $2 million purchase price. And then we go out and we raise $2 million in investor capital. And that investor capital comes in, we fund the purchase, and then cash flow is created from day one with these performing mortgages. And we use those monthly homeowner payments to pay our investors out on a monthly basis.
Oh, sure. Yeah. I was going back to the ones when you were, had started purchasing the non-performing residential mortgage notes and what we called as a re-performing residential, what I
Yeah,
said at the beginning. And so I'm just trying to, the helping them stay in their homes if they got a little bit
sure.
behind. And so I'm just trying to understand how that works with the homeowner who's behind, who's now is are they they're just starting to make the payments and it'll just be extended, or are they
Yeah.
or they not, or it's completely refinanced, so it's a whole new type of payment plan, or just trying to understand a little bit how the structure of the note that you buy when it's not a performing one to get figured in, so it's becomes a good performing note, because that's the goal,
Sure.
right? You're getting them
Yeah,
even a better discount than the performing ones, but you're putting them on track to be a performing note.
sure. So how that works is we have a private fund that just my partner and I own. We have about $40 million in debt that we manage in that portfolio. And so we'll buy in mortgages that are distressed. And normally what happens is one of three things occur in someone's life that stops paying. It's either love, they get a divorce, they lose their job, or they're underemployed, or something health related occurs. And from that point, the homeowners stop making payments. And so over a course of time, 2, 3, 4 years, at some point the lender or the hedge fund will bundle those into pools of distressed mortgage pools, sell them off to a company like ours, our private hedge fund, at a discount. And then we have a team of asset managers. We have a 20-person operation. We have people that will get on the phone with the homeowners. And what we find oftentimes is, now that it's been 3, 4 years later, the person's remarried, or they got their job back, or they got their health back. Something has occurred in their life where they're back on their feet and they're able to pay. And so what our job is to find out, determine where they're at financially, what they're able to pay, and then come up with a payment plan that hopefully matches what they're able to pay so that it's sustainable. And then we go and we create a loan modification, which is not a new mortgage. It's not a new mortgage that's originated. It's just changing the terms of the existing promissory note so that we can go adjust the duration, we can adjust the interest rate, the monthly payment, and so forth, and allow it to be affordable for the homeowner and to help them resume payments so they don't lose their house.
Okay, great. All right. So you said, do you take, so bequest funds is your performing fund management, and then this is a separate company, or just another fund where you offset the different returns for a balanced return for your investors?
Yes, so it's a whole completely different fund, privately owned, no investor capital backing that fund. It's what I've been doing since 2013. Bequest funds, we launched Bequest funds about 2.5 years ago, because what happened is, when I've written 3 books on the mortgage note industry, and so people started reaching out, and you're an author as well. People start reaching out. They want advice. They want help. And what I found is there's a lot of people that want to earn passive income, but they don't want to go and set up a whole entire note business for themselves. They're not looking for a huge endeavor. They're just looking to go put money into a fund and receive monthly income for life. And that's essentially what Bequest is set up, as an evergreen fund to do that.
Okay, great. So let's kind of ratchet back to some of the basics, like, because I just sort of jumped into note investing because I had looked into it, but there's probably a lot of people out there that they kind of know because they have a mortgage, and then all of a sudden they get an announcement that their mortgage is now being handled by somebody else. And I never really thought of that as being note investing. So what is note investing? Me on the consumer side, I got a mortgage that's been bought, but then I also kind of went out there, and you've got this book, Note Investing Made Easier: How to Buy Profit from Distressed Mortgages. So seems like that would be really risky. So what is note investing, and why would it not be as risky as other investments?
Sure. I often think of Robert Kiyosaki when I think of risk associated to an investment opportunity, and he always says that the risk is always associated to what you know and don't know.
Right.
So if you want something to be less risky, get to know that industry, get to know that product, get to know that asset class, and so on. And so the more that you become a student and you immerse yourself into an industry, the more that it'll become less. You'll mitigate risk and
right.
Receive profit as a result. But what I'll say is that with the mortgage note industry, there's a lot of compliance, there's a lot of nuances, there's a lot of attorneys that get used. So there is a sophistication that one needs to have. Now, it's not to discourage anyone from starting a note business and doing this. I mean, one should always it's actually good when barriers to entry are larger, right? I mean, that says that if you press through, then you'll have less competition. So because I can tell you for a fact that there's significantly less people in the note investing space than there is in the real estate, landlording and flipping, side of things. However, there is a lot more sophistication that needs to be addressed, or if you don't address it, like if you don't adhere to compliance, if you don't use a licensed servicer, then you put yourself and your company at a financial risk.
Okay, all right. So, you got started in this in 2009 time frame when you were investing in properties to own and manage and things like that, right? So it seems like, because that was right sort of at the peak of our real estate bubble being popped, in 2009 when that great recession was starting to happen. Was there was there a buzz about there about like buying these notes? Because there was so, I mean, most people go, oh, okay, I'm going to go buy a property that's in foreclosure or on the courthouse steps or because of tax stuff and things like that. Was it through that process that you were introduced to notes, and then, maybe had a mentor? Because I know you mentor other people, on this, and then, to get rolling on that? Or was it a natural evolution for you because of the knowledge base that you gained in buying the properties that you did at that particular time? It was such a unique time in our real estate value history in our economy in the US.
Sure. So I think it all kind of stemmed from what I wanted to do out of the gate, my wife and myself. And in 2004, when I left corporate America, my wife and I determined that we were going to do for ourselves, and we were going to start our own business, and we were not going to be beholden upon, any job or employer. And from that point forward, we took a lot of seminars, we read a lot of books. I mentioned Robert Kiyosaki. And so much of what we learned is that you needed to have a small business. You needed to have some enterprise that is providing ongoing cash flow to you as you are getting your investment career up and running. So I think a lot of times, some people may just go right into try to wholesale, and right in, bird dog, right? Try to broker transactions and try to jump the step of building a foundation, which is like a small business or some enterprise, or have some job that's producing some income on a steady basis, by which you can then start feeding your investment career through knowledge and through physical dollars. And so when we turned the corner in our government contracting company, the first thing we did is not go out and buy a boat or reward ourselves with vacations. We went and bought a building that we moved our company into.
Okay.
And then the next month we bought the building right next to us. And then we just started buying. So every time we started, got paid, hit a government contract, closed out, got a lump sum of money, we went out and bought another property. And so we just formed a discipline. So started with a passion, and then we followed a plan, and then formed a discipline as we were following that plan. That's kind of the lead up to note investing.
Yeah. Okay. So if somebody says, okay, they're looking into this as an asset class, and they say, you know what, I need to learn more about it. And I'm not sure if I should do it myself, and do little by little, like what Martin just talked about, or you know what, I like the idea of just having a reoccurring revenue stream, because that's where I want to get to, and I can just I don't have to have all the risks, similar to what I say about angel investors. They don't have to have all the risk of being an entrepreneur and starting at the company. You just put your money to work for that to get a piece of that success, right? So, would note investing made easier be the perfect one for the best book for somebody to say, yeah, I want to learn about this and then decide, and what would be the criteria that they would, like a self-assessment that they would say whether they have the financial wherewithal, the fortitude to build a portfolio like what you did before you went and started your performing mortgage note fund that is really throwing off the big returns for your investors?
Yeah. So I think everything starts with the passion. So when we sold our government contracting company in 13, I made a decision in my life, and that was the next profession, the next thing I do, I want to be of service to thousands of people. So I wanted to serve on a higher level. So I kind of grew out of that. I want to make $1 million. I want to make, I want to buy this. I moved out of that. It was kind of like an immature phase in my life where I was thinking of rewards in terms of physical possessions that I could acquire. And then I moved into like, I want to serve on a significantly higher level. And that's when I made that decision. Mortgage notes came about. So I found that as my vehicle where I could go and help a family that's struggling, go restructure their loan in a compassionate manner, and keep them in their home, which helps them, but it helps the neighborhood, it helps the state, it helps the country on a macro level. And so so once I really just started having alignment in terms of where I was at with my heart and where I was at with the service being provided, then from that point, we accumulated a lot of mortgages that were performing and held those. And they, I can't, I don't know the exact year where, all the money that's coming in passively from all those mortgages exceeded expenses and all that, financial freedom. But at that point, like it dawned on me, I wrote a few books and I was like, this is my experience. This is the steps if you want to start your own business. And what I learned is that there's a lot of people that are dying. They're desperate for more monthly income. They're desperate that dual income in their family isn't cutting it, single income. So they need more. They're losing ground as society's moving forward. Things are more expensive. Government's out of control. I mean, however you want to take it, and they feel like they're losing their grip, they're losing control. And so what BQuest, what my mission is about is helping the homeowners stay in their homes, but also helping create passive income streams so people can have more of a footing in this world, financially speaking.
And yeah, that's terrific. And that's particularly, so they go to, I should tell everybody, you need to go to BQ, right? BQuest Funds is bqfunds.com, bqfunds.com, to get more information about how to get involved in this program that Martin has, where his investors that basically co-invest with you, right? They're limited
Yes.
partners, you're the managing partner, but they're co-investing with you. And to get this, predictable, would you say 9% return on their funds on a regular monthly or annual basis? How does that pay out?
Yeah. So we pay out monthly. So if you let it compound, it's like 9.39%. And so I'm the largest investor physically in the fund too. So I'm not just the operator. I have the most
Yeah.
amount of money in the fund. So I am all in. Like what we're talking about here, like financially speaking, between my private fund and what I have in BQuest, like I am all in, like cash flow wise and everything else. This is my whole world. So this is what I believe when I talk to investors that come in the fund. But I think you mentioned something early on. There's going to be a lot of people that listen that aren't accredited investors. They don't have the liquidity. They're not going to be able to come into BQuest at this point where they're at.
Right.
And for those individuals, you have two choices, right? I mean, if you don't have the money to go and create more money, then you need to pull the sweat out. The sweat needs to occur, because you can't cheat life, right? So I for many years, I did 100-hour work weeks, putting in the sweat to get to the point where I started buying mortgages in 2013 and kind of starting to build a passive income. So you can check out other note investing books, not just mine, but if you're serious about this as a potential career, you should buy every note investing book on the first 2 pages of Amazon under note investing category. Read them all, and don't read them all to find out which one's the best. Read them all to take notes and build your whole action plan so that you can go to town and put in the sweat and be rewarded that way.
Yeah. Excellent advice. Very good. It, it is with everything. I mean, my book is robust. It's a primer. It's detailed on, the steps you have to take. Like I said, would you, should you, could you, to decide if you want to get involved in this. And once you decide, then you put a plan in place and work your plan. Right. So with the volatility of real estate markets, as we begin to wrap up here, is note investing risky, like even with your performing note portfolio?
Yeah. So the neat thing about performing mortgages is when we underwrite the mortgages that are purchased into BQuest funds, we not only look at the underlying collateral, which is the property. So yes, when real estate takes a hit, 10, 20%, drops in fair market value, that is only significant to us if the homeowner stops paying and we have to file foreclosure to take back the property. But we also vet the homeowner themselves and do a credit report analysis, do skip tracing, and we do other types of understanding of the homeowner and their ability to continue to pay. So our portfolio sits at under 65% investment to value, which is very conservative because we're buying these in at a discount. And we ensure that the mortgages have been performing in season before buying them into the fund. So we monitor that delinquency report on a daily basis to ensure that not only are they performing coming into the gate, but they're monitored daily to make sure that they continue to perform through the life cycle of the loan.
Yeah. And then if they end up becoming a non-performing because you have experience with restructuring those, you can either get them on track in that, or do you roll them out and then they're handled in a different way so it you can maintain the return on investment out of your bequest fund?
Yeah, that's the whole thing, is if they stop paying. I mean, that's our expertise, is working
Right.
with homeowners that stop paying. So yeah, we can start the foreclosure process. We can, but at the end of the day, our objective is to build deep-rooted relationships with the homeowners so that if they lose their job, they'll tell us. They'll be transparent. They'll know who our asset managers are, and they'll have some level of openness. And that's what we find. The better we treat our customers, which are the homeowners, the people paying our bills, the more they work with us and the more that we're first in mind when it comes to making their monthly
Yeah.
payment. So that's where you start the whole process. Then, lawyers and all that other stuff, that's